It is that time again for the free tax video update of the year! I am so grateful and so thankful to have you guys here today. This is the third year I have done this, where I come on camera and try to give you the most comprehensive free tax summary available on the internet. At least that's my goal, considering I'm a one-man show, and not a huge corporation. Let's get into the 2020 tax updates for your personal, your individual taxes. That's what this video is about. Because of the massive amounts of requests, I have one ready to go for the tax updates for business owners as well. I am working on filming that, and as soon as I have that ready, I will post it to the channel, so make sure you're subscribed so you don't miss that when it launches. Each year, the revised tax brackets income levels are changed just a little bit. As you guys can see, that these amounts have gone up a little bit since 2019, so this is definitely new and has been updated. And if you're new to taxes and don't know how any of this stuff works, the rates on the left-hand side, they're often referred to as your marginal tax rate, because this is the highest amount of tax you'll pay on each dollar you earn, and that is, you know, would be whatever tax bracket you fall within. And of course, not every dollar is taxed at that rate. It's like a ladder. The first portion of your income is taxed at 10%, the next portion of your income is at 12%, and then 22, 24, etc. You don't pay a flat 24%, for example, on all of your income. That's not how it works. Now, who loves investing? I absolutely do. You guys know that if you follow the videos on my channel. Talking about the long-term individual capital gain rates. As you guys can see, these numbers are relatively the same as what they were, but what I wanted to point out is that if your income's low enough, if you file single, you can actually make $40,000 in long-term capital gains or qualified dividends and pay $0 in tax. It's quite amazing. Get out! If you're married, check it out, you can actually make $80,000, your first $80,000 in dividend income. If your income is low enough in total, you'll pay $0 in tax.
Get out of here!
So some pretty cool tax advantages if you're selling investments you've held for long term, which means for more than a year and 1 day, or if you're receiving qualified dividends from companies like Coca-Cola, Pepsi, things like that. Taxed at a much, much lower rate than your wages. Real quick, before we go further into the spreadsheet, if you guys want to support the work I do on this channel, you can do so simply by dropping a like, or leave a comment below, or even consider sharing this video with others. If you do those things, what that does is it basically boosts the YouTube algorithm, and YouTube is more likely to share this information with other people. Thank you so much in advance, and I really appreciate you guys being here. Moving on down the line, let's talk about that standard deduction. And standard deduction, if you don't know what that is, it's basically a free tax deduction everybody gets to take every single year to help offset your income.
Free, 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 free.
So in 2019, that was $12,000 if you're file single or married filing separate. Head of household was $18,000 and married filing joint was $24,000. But in 2020, these amounts are slightly higher, which is good, which means we pay less tax, right? So $12,400 if you file single or married filing separate, and up to almost $25,000 or close to $25,000 if you do married filing joint. For those of you out there who are new to taxes and just learning how this works, the standard deduction is awesome because it helps offset your total income. And simply the way that works is if you, let's just say you have $100,000 in income is what you've made from your job, and you file single. Well, and for 2020, we just looked at the standard deduction is $12,400. So your standard deduction takes away from that income, and now you are taxed not on $100,000, but $87,600, and that's how that works.
I like the sound of that.
Moving down the line real quick to medical expenses. Now this is pretty cool. So we didn't think that the 10% of AGI threshold was going to stay in place, but it has. So for your medical expenses, if your total medical expenses for the year exceed 10% of your adjusted gross income, at that point they become deductible and you actually get a tax benefit from that. And that's at any age. You no longer have to be, like a senior or, over the age of 65 in order to receive that treatment. Now, people of any age, as long as your medical expenses are 10% of your AGI or greater, those are now deductible expenses. And I've put a little note here just to clarify, is that expenses must exceed 10% of AGI before they become deductible. So in other words, when you're virtually on your deathbed, that is when the IRS says, okay, we'll give them a tax deduction. Some of the numbers are still in the process of being updated by the IRS, but in terms of your medical mileage deduction rate, it's about 20 cents per mile is what to expect. In 2018, and I'm sure in 2019, we're seeing more people than ever before able to claim the child tax credit, which is huge. This is a wonderful credit. It's up to $2,000 per qualifying child, and it's refundable up to $1,400. And if you have a non-child dependent, that credit amounts to $500. So still the same amounts as they were as last year, but one of the best tax credits available today. So take a moment out of your day and give that horribly disobedient child you've raised a hug, because they're saving you $2,000 per year with tax credits until they're the age of 17. After that, kick them out. State and local taxes. If you guys remember, starting in 2018, you're limited in total for your property taxes, your income taxes, your state and local property taxes and things like that. Your taxes you pay for your registration on your vehicle at the DMV, those sort of things. All of that is limited now to $10,000 per year max. For mortgage interest deductions, these are pretty much still the same as they were before. You're still limited to $750,000 for any new loans that have occurred, or any new mortgages that have taken place after 2017. Your home equity loan interest is only deductible if you use it to acquire real estate or fix up your existing real estate. So if you guys remember, miscellaneous itemized deductions are no longer a thing. You used to be able to deduct your legal fees, your tax preparation fees from your accountant. Maybe you had uniforms or union dues and things like that. For federal tax purposes, that's no longer an option, but you might be able to get an itemized deduction for state purposes. Like, I live in California, so I can still itemize these expenses for California, just not for federal. Let's talk about education expenses. Not really much has changed here, but it's still good to point this out because these deductions and credits save people a lot of money. There's the student loan interest deduction. It's still limited to $2,500. These are the income phase-out ranges over here. So once your income goes above these amounts, that's when you start to lose the advantage of this deduction dollar for dollar. The American Opportunity Tax Credit, that is $2,500, and that's per student, and that applies to the first 4 years of post-secondary education. So if the first 4 years of college is when that credit comes into play. The Lifetime Learning Credit is a credit of up to $2,000 per year per student, and this is usually the person who's getting this credit usually can no longer take advantage of the American Opportunity Credit, or they're usually pursuing their masters, or they love school, they just keep going back.
I love my school. I love my school.
And that's the deduction they might be able to take if they're in the right income range. They can take advantage of that. Now, I have separate videos on the channel of how these credits work. You'll find my complete tax video playlist at the bottom of the spreadsheet. You can find them, and the rules those videos are like 2 years old, but the rules are basically the same. It's the same rules as it's been for the last several years, so you can check out those videos if you'd like to learn more about that. All right, couple updates here in the 401k arena. So in 2019, your maximum deduction if you were under the age of 50 was $19,000, and $25,000 if you were over the age of 50. In 2020, these amounts bump up a little bit. You can now contribute up to $19,500 to your 401k in 2020 if you're under the age of 50, or $26,000 per year if you're over the age of 50. So if you contribute $19,500 to your 401k in 2020, you're going to reduce your taxable income for 2020 by $19,500. So it saves people a lot of tax. But of course, all good things come to an end. So eventually when you take that money out of your 401k, once you're above the age of 59 and a half, that's when you start paying tax on that money. For 2019, the contribution deadline for a Roth IRA or a traditional IRA is 4/15 of 2020. So here are the amounts. It's basically the same as they were last year. So $6,000 per year if you're under the age of 50, $7,000 per year if you're 50 and up. Social Security, the COLA adjustment. The COLA adjustment always makes me think of like Coca-Cola or Pepsi.
I'd like to buy the world a Coke and keep it company.
In 2019, the COLA adjustment was 2.8%. Much more meager adjustment in 2020, where it's only 1.6%, but that's what it is for 2020. As you guys are probably well aware of, the alimony rules are in effect, basically meaning that if you didn't have a court order document prior to this with an alimony agreement, then you're pretty much stuck using the new rules, whereby if you pay alimony, you can no longer deduct it. And the way it works is the person receiving the alimony now does not report it as income. Now, why is that? Many people ask me is the reason that is because the person who usually pays the alimony usually has the most money. They are usually in the higher tax bracket. And so the IRS wants that person to pay the tax on that money because they're going to get a higher rate of tax from that person if they have to report the income. Gift taxes, the annual exclusion for 2019 is $15,000. Same for 2020 is $15,000. That's per person. So that means you can gift a person, whether it's cash, property, whatever, up to $15,000 per year without having to file a gift tax return. And if you're a married couple, you can actually, between husband and spouse, you can actually give your son or daughter or whomever $30,000 in total and still not have to file a gift tax return. But just remember, who pays the tax on the gift? The parents, or the donor, the person donating the gift, they're the ones who pay the tax. However, in reality, most people never pay any tax on gifts because the estate tax exemption for gifts, it is $11.58 million. So unless you gift above $11.58 million, if you're single, or $23 million if you're married filing joint, you will never pay a dime in gift taxes. For even if you give hundreds of thousands of gifts, you would still fall well below those limits. So don't worry about paying gift taxes. Just know when you have to file a gift tax return, and that's whenever you exceed the annual exclusion amount. AMT, these are the new phase-out ranges. It's $518,400 if you're single, and $1,036,800 if you're married filing joint. The Affordable Care Act, okay, the penalties have been repealed on that. So if you don't have health care insurance, you're good now. You're no longer going to be penalized on that. Ironically, the people who were being penalized for not having health care insurance could not afford the affordable health care insurance, so they decided to rescind the penalty. No! Casualty theft losses, really no longer deductible unless you live in a disaster area. Moving reimbursements, really no longer a thing unless you are served in the armed forces. Charitable deductions, they're now 60% of your adjusted gross income versus 50%. So you can donate up to that amount of your AGI and get the deduction. Health savings accounts limits have gone up a little bit. So it is now $3,550 per single filer, or $7,100 if you have a family. And these are the minimum health insurance deductible amounts to qualify for the HSA. If you can get an HSA, I highly recommend you do so. They are one of the best tax savings and just medical savings accounts on the market. I don't think there's anything that beats it. Because truly, once you put money into this, it is a permanent tax deduction. The only time you would ever be taxed or have to pay a penalty on that money is if you were to ever use that money that goes into that account for a non-qualified medical expense. Adoption tax credit amounts are pretty much still the same as they were, and still one of the best credits you can get if you are adopting. These are the earned income credit, or the income ceiling plateau amounts for 2019. These are the most current numbers I have. I don't know if the numbers for 2020 have been released, but so these are the best numbers we have, or this is probably what I would go by for now. Net operating losses. Now, I've added this to the spreadsheet. I didn't have this last year. If you have a net operating loss, known as an NOL, maybe you have a business and maybe your business lost a bunch of money this year. Well, the most you can deduct in 1 year if you take a loss is 80%. So let's say you have a net operating loss of $40,000. Well, the max you can deduct to help offset your other forms of income that year is 80% of that. So you could only use that much, $32,000 in this case, of your NOL in that example. The other remaining $8,000 of that would carry forward to a future year, and then of course you could use them in the future years. A lot of people ask me the standard mileage rate, so I made sure to include that on the spreadsheet this year. I think I included it last year as well, but it's 58 cents per mile for 2019. The numbers for 2020 have not been released yet, so for the time being, just assume it's 58 cents as well. The $199A deduction, there's a few updates to the total phase out amounts this year. I'm not going to cover those in detail because we're going to cover that more in the business tax update video. But if you want to pause the video and look at those amounts, if you want to download the spreadsheet, you are so welcome to do so. Then here we go down here. This is one of the things I wanted to add to the spreadsheet is tax penalties. A lot of people are blindsided by tax penalties, and you know, we really shouldn't be, but unfortunately our school system and our society does not educate you on taxes. They leave you completely clueless when it comes to taxes, especially when it comes to penalties. So most people, when a penalty hits them, it hits them out of the blue. It's like a punch in the face out of nowhere.
Give me your... How was that?
And so these are these are some of the biggest penalties I see on a regular basis as a CPA. The RMD penalty is the largest tax penalty I know of, but basically what that means is that if you have a 401k or a traditional IRA, you're required by law to start withdrawing the minimum amount out of that account every year, starting at age 70 and a half. Now, there's a new bill that just passed that I will be looking into further. So I believe for 2020, the required minimum distribution age is now 72. I need to confirm that. These next two penalties affect a lot of people. There's the failure to file penalty, which means that if you fail to file and you owe a balance due, well, it's going to accrue at a rate of 4.5% per month on that balance due. Ouch. Up to a maximum amount of 25% of the balance due. So look out for that. Failure to pay penalty. This one hits a lot of people. This is the most common tax penalty I see. And it's not a lot of money, but it is 0.5% per month. So it adds up pretty quick. And plus, what's not listed here because it's not a penalty is interest. You're gonna pay interest on top of this. So you're gonna pay 0.5% per month, and then whatever the AFR rate is at this point in time, if you owe money and if you don't pay your taxes in time. This year, I've included at the bottom of the spreadsheet, if you want to follow all of my tax videos and where they're at, you can find my complete tax video playlist right here. This is every tax video I've ever produced so far on the channel, and I will continue to produce tax videos going forward. Currently, I have 34 tax videos in all, covering everything from personal taxes to tax estimates to tax extensions to business taxes, child tax credit, and so on and so forth. You guys can just go on down the list, and that link is in the spreadsheet for you to check out. I think we've made it through another year with this update. I really hope you enjoy this. I get so many positive comments around the spreadsheet, so every year I continue to produce this spreadsheet. I want to continue to make this for you guys and give this to you for free. If you guys enjoyed the video today, make sure you let me know by dropping a like, leave a comment below, let me know how these new tax laws are affecting you. Are you paying more in tax? Do you find yourself paying less in tax? Are you able to itemize anymore? I know I'm not. Now my wife and I take the standard deduction, which turns out to be even more favorable for us. So for us, we're paying less tax, but what about you guys out there? What's going on with your tax situation? Is it better or worse? Let me know in the comments. If you're not already subscribed to the channel, make sure to do so. Every single week on Money in Life TV, we're here to help you become fiscally fit. And we do that by teaching finances, investing, taxes, and more on a regular basis. I hope you got a lot out of this spreadsheet. Make sure to download it. I love you guys. I'll see you in the next video. Live life uncaged and have a great week. Peace.